When news about rising global tensions starts dominating headlines, most people immediately think about politics, security, and the risk of escalation. But there's another question that quietly begins to circulate among investors around the world. What happens to your money if a global conflict actually begins? Financial markets are deeply connected to geopolitics, trade, energy supply, and economic stability. When tensions rise between major nations, the effects can quickly spread through stock markets, currencies, commodities, and investment portfolios. Global conflicts have historically been powerful forces shaping financial markets. Sometimes they trigger sharp downturns. Sometimes they create unexpected opportunities, and often they do both at the same time. To understand whether your investments are safe during a global conflict, it helps to look at how markets have behaved during past geopolitical crises. One of the first things that usually happens when conflict begins is a surge in uncertainty. Markets dislike uncertainty more than almost anything else. When investors don't know what will happen next, many quickly reduce risk. That often leads to sudden sell-offs across global stock markets. This is why stock indices can drop sharply during the early stages of geopolitical crises. Investors move money out of stocks and into assets perceived as safer. These movements are often driven by fear and risk management rather than long-term economic damage. But what many people don't realize is that these reactions are often temporary. History shows that markets frequently stabilize once investors better understand the scale of the conflict. Even during major global events, markets often adapt faster than expected. Looking at past geopolitical crises, stock markets often dropped at first but later recovered once economic systems adjusted. Investors who sold during the panic frequently missed the recovery that followed. However, different assets react in very different ways during global conflicts. One of the biggest beneficiaries in many geopolitical crises has historically been the energy sector. If conflict threatens major oil-producing regions or key shipping routes, energy prices can surge. Oil, natural gas, and related energy companies often benefit from supply disruptions. Energy markets are extremely sensitive to geopolitical events. Even the possibility of disrupted supply can push prices higher. For investors holding energy stocks or commodity-linked investments, this can create significant upside during periods of tension. Another asset that often gains attention during global instability is gold. For centuries, gold has been viewed as a store of value during uncertain times. When investors worry about inflation, currency stability, or systemic risk, demand for gold tends to increase. That is why gold prices often rise during wars, financial crises, and geopolitical shocks. Government bonds, particularly those issued by stable economies like the United States, also tend to benefit from what investors call a flight to safety. During uncertain periods, many investors prefer assets backed by governments rather than riskier investments. However, not every sector performs well during global conflict. Industries that depend heavily on global trade can face disruptions. Shipping companies, airlines, tourism businesses, and international supply chains may suffer if transportation routes become unstable or costs increase. Consumer-focused industries may also weaken if economic uncertainty causes people to spend less. When households become concerned about inflation or economic instability, discretionary spending often declines. Technology stocks can also face volatility in some conflict scenarios. Many major tech companies rely on complex global supply chains. Semiconductor production, electronics manufacturing, and hardware components are often distributed across multiple countries. If geopolitical tensions disrupt these supply chains, tech companies may experience short-term pressure. At the same time, other industries may benefit. Defense companies frequently see increased demand during periods of geopolitical tension. Governments often raise military budgets, invest in advanced defense systems, and expand procurement of equipment and security technologies. Cybersecurity companies may also benefit. Modern conflicts are not fought only with traditional weapons. Cyber warfare, digital espionage, and infrastructure protection have become major strategic priorities for governments worldwide. Currency markets can also react strongly during global crises. In times of uncertainty, investors often move capital into currencies considered stable. The U.S. dollar has historically strengthened during many global crises because it is viewed as the world's primary reserve currency. A stronger dollar can influence global markets in multiple ways. Emerging market currencies may weaken, commodity prices may shift, and multinational companies may experience changing revenue dynamics. But perhaps the most important factor during global conflicts is investor psychology. Financial markets are driven not only by economic data, but also by human behavior. Fear, uncertainty, and panic can lead investors to make decisions that hurt long-term returns. Reacting emotionally to headlines often results in selling at the worst possible moment. The real challenge during global crises is separating short-term volatility from long-term strategy. Experienced investors understand that geopolitical shocks are a normal part of market history. Wars, political crises, economic downturns, and financial shocks have occurred many times before. Yet despite these disruptions, global markets have continued to grow over the long term. That does not mean risks should be ignored. Instead, global conflicts highlight the importance of diversification. A diversified portfolio spreads investments across different sectors, asset classes, and geographic regions. This reduces the impact that any single event can have on overall performance. Some investors also include assets that historically perform well during instability, such as commodities or precious metals. These assets may not always outperform during stable periods, but they can provide protection during extreme events. Another useful strategy during uncertain times is maintaining some liquidity. Investors with cash or liquid assets are better positioned to take advantage of opportunities that may appear during market downturns. Because during periods of crisis, markets often become highly volatile. Prices can swing dramatically in response to news developments. But that volatility can also create opportunities for disciplined investors. The key lesson from past conflicts is that markets eventually adjust. Initial panic often gives way to rational analysis. Economic systems adapt, businesses adjust operations, and investors return their focus to long-term fundamentals. For investors, the question should not simply be whether markets will react to a global conflict. They almost certainly will. The real question is whether your investment strategy is prepared for that volatility. If your portfolio is concentrated in one sector or market, geopolitical instability could create significant risk. But if your investments are diversified across industries and asset classes, the impact may be far more manageable. Because in the end, the goal of investing is not predicting every global event. No one can forecast every crisis, conflict, or political shift. The real objective is building a strategy capable of surviving uncertainty. Global conflicts may shake markets in the short term, but history shows that disciplined investors who remain focused on long-term fundamentals often emerge stronger once the uncertainty passes. So if a global conflict were to begin tomorrow, markets would almost certainly react. But the real question is not whether markets will move. The real question is whether your portfolio is prepared